since several years now. For several years, we have not seen any central banks net buy bonds. More have sold than bought. They're all buying gold. And so this is a situation where I don't think we've seen anything yet. And maybe it's a realization by Trump that this is a game, as Zoltan Pozsar says, he who has the gold makes the rules. He said Bretton Woods 3, we're moving into a system that's all about commodities and transparency. Blockchain, gold, we're moving there. So maybe Trump is ahead of the curve here and is onshoring our gold before it gets siphoned off across the globe, because we were so stupid in the West for all of these years to suppress gold and silver, playing right into the hands of the countries that are saying, thank you, we'll stand for delivery. And that's what's different than anything I've ever seen. These countries are sophisticated, motivated, coordinated, and wealthy. Give me the damn metal. I don't want more paper. What we see now is certainly intriguing and outside the norm. But when you start to see a run on these institutions, force majeure on the COMEX, God only knows what on the LBMA, I think it could get interesting, and maybe it's just tariffs. Don't know, but these are the times we live in. Very fluid, very interesting, certainly worth keeping your eye on the ball. Because we're talking about gold, look, many of the same things are happening with silver too, Ivan, and maybe in spades. To me, I'll just say this regarding silver, and I know that's what your listeners predominantly own and think about and research. Only the duality or plurality, that's a word, in demand between military and green and digital and monetary. Yeah. That's depleting in nature, increasing in demand, been held down in price forever, probably by the military industrial complex so they can make high-tech weapons. But whatever it is, I don't know that there's an asset that offers the upside that silver does with the mitigated downside. And we've seen, 14, 15 million ounces of silver stand for delivery recently also, if not more. I haven't seen what happened here just recently, the recent commitment of traders. But there's a lot of silver coming in to the U.S. as well. It's not just gold that's being imported. So as one goes, so too does the other. They have about a 90% correlation through all of history. Maybe not in perfect unison, but one won't go to the moon without the other. So I know we said gold, but I'm just as bullish and probably more bullish on potential on silver.
For years now, we've witnessed a quiet yet seismic transformation taking place just beneath the surface of the financial system. Central banks, those very institutions that for decades served as the backbone of fiat currency confidence, have been selling bonds and buying gold. Not in dribs and drabs, not as a novelty, but in a sustained, calculated, and almost desperate wave. And not just any central banks. We're talking about the People's Bank of China, the Reserve Bank of India, the Central Bank of Turkey, even the Bundesbank and the Banque de France. You name it, they're all in on this shift. So why does this matter? Because we're no longer in a system where paper promises hold the same weight they once did. As Zoltan Pozsar aptly put it, he who has the gold makes the rules. That's not poetic license. That's the ground-level blueprint for Bretton Woods 3, the new commodity-based monetary system rising from the ashes of over-leveraged fiat. Donald Trump may understand this better than many give him credit for. Maybe that's why his administration laid the foundation for tariffs and supply chain reshoring. Maybe that's why we've seen a wave of physical gold being imported into the United States at a scale never seen before. 13 million ounces from London alone in the past few months, with even more coming from Switzerland, Singapore, and other vaulted hubs. And this isn't just about investment. This is national strategy. In a world where trust is eroding, where inflation is sticky, debt is unpayable, and monetary policy is trapped, gold is the insurance policy, the final anchor. Let's not forget what happened with Roosevelt in 1933. He confiscated private gold at $20.67 an ounce, only to immediately devalue the dollar by raising gold's price to $35. In doing so, he artificially boosted the government's balance sheet and reflated the system. Today, every central bank in the West still marks its gold reserves at either $35 or $42.22 per ounce, levels set in the 1970s. Meanwhile, we're looking at gold brushing up against $3,000 in real markets. So what happens if we do it again? What happens if the United States Treasury revalues its gold to even $10,000 per ounce? Well, based on current reserve estimates, around 261 million ounces, that would generate nearly $2.6 trillion in new liquidity. At $20,000, you're adding $5.2 trillion. That's real money, free and clear. And it doesn't even require raising taxes or issuing more debt. That's why central banks are doing it quietly while everyone else is watching Bitcoin or Tesla or Nvidia. They're not trying to ride the hype. They're preparing for the reset. Let's break this down even further. Since last November, the United States has become a net importer of gold. Let that sink in. For decades, we were net exporters. Suddenly, the flow has reversed, and it's not small. The largest delivery ever recorded on the COMEX was in February, totaling nearly 6 million ounces, far surpassing the pandemic era, 2020 deliveries of 1.2 million ounces, and even blowing past the second highest mark of 4.8 million. That's not normal. That's historic. And look who's involved. JP Morgan, delivering $4 billion worth of gold into the COMEX system for an undisclosed client. JP Morgan doesn't hold gold for itself. It explicitly states that it only acts on behalf of customers. So who's got the dry powder and the conviction to drop $4 billion on physical gold delivered into New York? Your guess is as good as mine, but I'd wager it's someone close to the Treasury or Federal Reserve, someone who knows what's coming. Now pair that with what's happening in London. The LBMA, supposedly the most liquid gold market in the world, is suddenly 6 to 8 weeks late on deliveries. Not T+1, like it's supposed to be, but T+40. And the excuse, not enough trucks, not enough manpower. Come on. If it smells like a duck and it walks like a duck, it's probably a duck. That, my friends, is a default in slow motion. Now don't think for a second that this story ends with gold. Silver is every bit as much a part of this transformation, and perhaps even more explosive in terms of price potential. Silver has a dual identity. It's both a monetary metal and an industrial one. And where gold is accumulating quietly in vaults, silver is being consumed by the military, by solar panels, by 5G tech, by electric vehicles. You don't get it back. Once it's used, it's gone. That's what makes silver so fascinating. There's a critical shortage looming. The Silver Institute reports massive structural deficits over the last several years. India alone has imported over 800 million ounces of silver in just the past 5 years. That's more than the total silver inventories of COMEX and LBMA combined. And while central banks aren't directly buying silver like they are gold, it's likely because they can't. There's no vault large enough and no strategic reason to hoard what is quickly becoming a consumed asset. So it's being quietly scooped up by sovereign wealth funds, military contractors, and industrial players who know what's coming. And let me ask you, if silver was just some archaic relic, why is it that 15 million ounces recently stood for delivery on the COMEX? Why are Indian refiners scrambling to secure forward contracts? Why are U.S. mints reporting months-long delivery delays? It's because, as with gold, something very big is shifting.
All I can tell you, whatever we're seeing is way off the charts, Ivan. It's an anomaly in terms of anything I've ever seen in my career. And it seems to be American-centric. It seems to be we're reshoring the gold. Now, what are they going to do with it? Are they going to follow Judy Shelton's lead and collar it to 50-year treasuries, redeemable in gold? She told me Trump will issue them July 4th, 2026, the 250th year anniversary, that they've discussed it at length.
Wow.
Is it something else? Is it playing that spread between London and New York, but the shipping costs alone mitigate that profit? Is it backing the naked contracts that, you know, the massive naked contracts and the rehypothecation, or the commercial banks wising up, bringing that gold home? It's not, certainly just not the Trump tariffs, whatever it is, and I'm not sure exactly what it is. Maybe it's the Basel III regulations where you have to have physical metal instead of paper derivatives. All of these things are in play. Or is it something much bigger? Are they going to revalue gold? After all, it's held in the gold revaluation account at $42.22 an ounce. That's the value of it, and that's the name of it on every central bank balance sheet. Get that, the gold revaluation account. You can't even make it up.
Wow.
In Europe, it's at $35 an ounce, but after Nixon closed the gold window in 71, he revalued it from 35 to 38 in 72, and from 38 to 42.22 in 73, where it stood forever. So on the United States balance sheet, if the gold is really there, they're going to go look. It's valued at 42.22. Just marking it to market would add 800 billion to the treasury coffers. What if they go much further than that? And it's happened. It's not without precedent. I don't know. It's interesting that central banks hold gold in what's called the gold revaluation account. That's in essence what Roosevelt did when he confiscated gold at $20.67 or whatnot for every $20 gold coin. People were like, yeah, we're getting a premium. It's fantastic. A dozen eggs are a nickel back then, 67 cents. I think it was 2067. That's a lot of money. Well, then he revalued gold or devalued the dollar by 40%, putting gold at 35, just like that. And so it's happened.
Right.
And then you have the head of the Dutch National Bank and members of the Bundesbank for 2-3 years screaming, let's revalue the gold, held in the gold revaluation account to offset our liabilities on our balance sheet. And even Cynthia Loomis, the senator from Wyoming, let's revalue gold, she says. Let's revalue gold so that we have the ability to buy Bitcoin for the strategic Bitcoin account. So I don't know, man. All I can tell you is this, that whatever is going on is a wicked anomaly. It's way outside the realm of what normally is. And I don't know. I guess only time will tell, but interesting times for gold no matter what.
What we're witnessing right now is not just a bull market in gold and silver. It's a historic reordering of the global monetary architecture. And the evidence is all around us for those willing to look past the headlines and into the vaults, literally. For years, Western nations, led by the United States, engaged in a policy of suppressing precious metals through the use of leveraged paper contracts. Contracts that could be issued in vast quantities without being backed by physical gold or silver. This created the illusion of abundance while quietly bleeding actual supply into the hands of more patient, longer-term, and far more strategic players. Central banks across the globe, especially those in the BRICS nations, the Gulf, and even parts of Europe, have steadily offloaded U.S. treasuries while acquiring and repatriating gold. According to the World Gold Council, net central bank gold purchases have remained positive for years now, with 2022 and 2023 setting multi-decade records. This tells us everything we need to know about where the smart sovereign money believes the future lies. It's not in fiat, and it's certainly not in paper claims. It's in real, tangible monetary metals. At the same time, silver, gold's historically shadowed counterpart, is being hoarded by those who understand its value not only as a monetary hedge, but as an industrial and strategic asset. Silver demand is now coming from 4 distinct fronts: investment, green energy, digital tech, and military hardware. That's a level of demand convergence we've never seen before. And yet, silver remains grotesquely underpriced, still below its 1980 high in nominal terms, even as gold flirts with $3,000. That's not just a market anomaly, it's a time bomb. The massive divergence between gold's current highs and silver's comparative underperformance highlights a setup that could become explosive. While gold has broken out decisively, silver has quietly been building a base, coiling like a spring. And make no mistake, when silver breaks, it won't be a slow grind. It'll be a vertical move, the kind of repricing that shocks even seasoned investors. Why? Because silver is the most thinly traded of all the major metals on the COMEX and LBMA, with the most distorted leverage. For every real ounce of silver in London, nearly 10 to 15 paper ounces are traded daily. According to the LBMA's own data, over 2.9 billion ounces are traded per day in London, more than 3 times the entire annual global mine supply. This is not a functioning price discovery mechanism. It is a synthetic construct that is now under siege by physical demand, especially from India, Turkey, China, and even the United States, which in recent months has become a net importer of gold and silver for the first time in decades. This reshoring of metal is not a coincidence. It is part of a broader geopolitical and monetary reset, one that many believe the Trump team is already preparing for. As Andy Schectman has often said, this could be the precursor to a new form of dollar, perhaps a gold-backed stablecoin issued by the Treasury, pegged and redeemable against a revalued U.S. gold hoard, marked to market from its current 1970s-era valuation of $42.22 an ounce. The implications of such a move are staggering. A revaluation of gold to even $10,000 an ounce would instantly add trillions to the U.S. Treasury general account without issuing more debt or printing more fiat. That would fundamentally alter the nation's balance sheet and its standing in the global financial order. And silver, which shares a roughly 90% historic correlation with gold, wouldn't just tag along, it would catapult. Silver's industrial utility, particularly in solar panels, electric vehicles, 5G infrastructure, and weapon systems, makes it irreplaceable. Yet unlike gold, central banks aren't accumulating silver in vaults. That means the upside potential remains in the hands of retail investors and private institutions who get in before the surge. Silver is being physically drained from the London Bullion Market Association and COMEX warehouses at record pace. We've already seen massive deliveries, 15 million ounces or more in recent months, being stood for by non-bullion banks, sovereign wealth funds, and private family offices. These aren't speculators. These are entities with inside access and patient capital, standing for real metal and removing it from the system. That alone should tell you that the paper game is nearing its limits. At the same time, we're entering a critical phase where macroeconomic stress, central bank policy reversal, and geopolitical tensions are all converging. The Fed, which had long postured as if it could fight inflation by hiking rates, now finds itself cornered. The banking system is buckling under the weight of unrealized bond losses, commercial real estate defaults, and collapsing lending activity. Rates may be high, but the system can't handle them, and everyone knows it. So the pivot is coming, and when it does, it will come with a new flood of liquidity, only this time into a supply chain and monetary structure that no longer trusts fiat. This is the key distinction of this cycle. Gold and silver aren't rising because inflation is high. They're rising because the faith in the monetary system is evaporating. The central banks get it. The insiders are moving. The question is, will the average investor wake up in time? And while all this happens, retail investors in the West remain enamored with crypto distractions and overpriced tech stocks. They don't realize they are the last ones to the party. As Peter Schiff has said repeatedly, Bitcoin is the millennial gold only in narrative, not in reality. When the panic sets in, people won't be running to digital assets that have zero yield and infinite counterparty risk. They'll be scrambling to secure the one asset that has never failed across thousands of years: gold, and increasingly silver. Silver's role in a monetary reset may be underestimated, but it's not unnoticed. The military-industrial complex cannot function without silver. It's in missiles, drones, satellites, and even hypersonic weapons. It's a strategic asset. The idea that we've allowed its price to be suppressed for decades is more than just a market distortion. It's a national security risk, which is why it is likely that we are seeing efforts to quietly hoard it ahead of a systemic shift. This is why Andy Schectman and other top analysts are calling this the most bullish setup for gold and silver in our lifetime. It's not just about price charts or interest rates. It's about structural exhaustion of a debt-based monetary model and the transition toward one backed, if not explicitly, then implicitly by real commodities. Basel III regulations, coming into full effect in July, are already reshaping the way banks treat gold on their balance sheets. Gold is now a Tier 1 asset under the Net Stable Funding Ratio, NSFR, meaning banks must have full physical backing for what they report on their books. This alone changes the incentive structure for bullion banks, who for decades profited off the arbitrage between paper and physical. That game is ending. The COMEX is bleeding physical inventory, and the LBMA is weeks behind in deliveries. The market is broken, and when a broken system can no longer function, the only thing left is a repricing to restore equilibrium. So to the retail investor wondering whether they should own some silver, yes, not only should you own some, you should understand why it may be the only asymmetric trade left in financial markets. It is being drained from the system. Its industrial utility is skyrocketing. Its monetary role is returning, and the very structure of the market that has suppressed its price for 40 years is now collapsing under the weight of physical delivery demands. You don't need to believe in conspiracy. Just follow the data, follow the metal, and follow the central banks, because they're not buying Bitcoin. They're not buying Nvidia. They're buying gold, and they're quietly letting the silver run out while the masses remain distracted. The question is, will you be the one who front-runs the herd, or the one who gets trampled when the stampede begins? Because once this breakout happens, there's no going back.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.